Legal disclaimer. The following content is strictly for educational, informational, and entertainment purposes only. It does not constitute financial, investment, tax, or legal advice. Foreign exchange Forex trading carries a high level of risk and may not be suitable for all investors. The high degree of leverage available in the Forex market can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment. Therefore, you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading and seek advice from an independent financial advisor if you have any doubts. Any mention of historical performance, specific trading strategies, or case studies is for illustrative purposes only and is not indicative of future results. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed. By continuing to watch, you acknowledge that you are solely responsible for your own financial decisions and that the creators of this content accept no liability for any direct or consequential loss arising from the use of this information. 90% of retail traders lose 90% of their account balance within their first 90 days of trading. That is not a scare tactic. That is not a random number pulled from thin air to frighten you. That is the statistical reality of the foreign exchange market, known as the 90/90/90 rule. It is a statistic that has held firm for decades, chewing up aspiring traders and spitting them out faster than they can deposit their second paycheck. If you are watching this right now, chances are you have already felt the sting of a trade going south the second you clicked buy, almost as if the market was watching your screen, waiting for you to make a move so it could do the exact opposite. You have likely experienced that sinking feeling in your stomach when a stop loss is hit, only for the price to immediately reverse and go in your original direction. You might feel like the game is rigged. And here is the controversial truth that most educators are too afraid to tell you because they want to sell you a course. In many ways, it is rigged. But it is not rigged by a person pulling a lever. It is rigged by liquidity, by institutional algorithms, and by the sheer, overwhelming psychological warfare that the market wages on the unprepared mind. The market does not care about your rent money. It does not care about your dreams of financial freedom. The market is a mechanism for transferring wealth from the impatient to the patient, from the emotional to the disciplined, and from the uninformed to the informed. Most people enter the Forex market viewing it as a slot machine where the odds are 50-50. They think the price can only go up or down, so they have a fair shot. That is the single most dangerous misconception in finance. When you enter this arena, you are not stepping into a casino. You are stepping into a battlefield where you are armed with a retail trading app and a few $100s, standing against central banks, hedge funds, and high-frequency trading algorithms that operate with billions of dollars and process information in microseconds. These entities are not guessing. They are not hoping. They are executing mathematical models designed to seek out liquidity, your liquidity. However, there is a way to survive. There is a way to stop being the prey and start operating like the predator. There is a specific, methodical approach to analyzing price action that allows you to align your small boat with the massive tide of institutional money, rather than trying to swim against it. If you have ever wondered why some traders seem to effortlessly pull profits from the market while you struggle to break even, it is not because they are lucky. It is because they understand the language of the market, and you are still trying to read the alphabet. This is the promise I am making to you today. We are not just going to talk about moving averages or crossing lines on a chart. We are embarking on a comprehensive 10-part deep dive masterclass that will fundamentally deconstruct how the Forex market actually works. By the end of this series, the confusion that clouds your charts will be replaced by clarity. We are going to strip away the noise of news events, the anxiety of flashing red numbers, and the paralysis of analysis. We are going to solve the problem of inconsistency. The biggest pain point for any trader is not losing money. It is not knowing why they lost money. When you lose and you do not know why, you are gambling. When you win and you do not know why, you are gambling with a temporary lucky streak that will eventually end in disaster. This masterclass is designed to move you from the category of gambler to the category of risk manager. We are going to solve the problem of emotional trading by giving you a framework so robust and logic-based that there is no room for feelings, only execution. We need to set the stage properly because if you skip the foundation, the house will collapse. You need to understand the sheer magnitude of the environment you are stepping into. The Forex market is the largest, most liquid financial market in the world. We are talking about a daily trading volume that exceeds $7.5 trillion. To put that into perspective, the New York Stock Exchange trades about $20 to $30 billion a day. The Forex market is over 200 times larger than the biggest stock exchange in the world. This massive volume is what provides the opportunity, but it is also what creates the volatility that destroys accounts. Because the market is so large, it cannot be cornered or controlled by any single individual, but it can be moved by geopolitical events, interest rate decisions, and macroeconomic data, releases that cause violent price swings. In this series, we are going to dissect these drivers. We are going to look at the why behind the what. Most tutorials show you a pattern, a head and shoulders, a double top, a flag, and tell you to sell or buy. That is surface level thinking. That is the equivalent of trying to drive a car by looking only at the speedometer and never looking through the windshield. We are going to teach you to look through the windshield. We will explore why a double top forms in the context of institutional order flow. We will explain why support and resistance levels hold, and more importantly, why they break when you least expect them to. You are going to learn that successful day trading is not about predicting the future. No one can predict the future. If anyone tells you they know where the euro is going to be in 10 minutes with 100% certainty, they are lying to you. Successful trading is about probability management. It is about identifying scenarios where the statistical likelihood of outcome A is significantly higher than outcome B, and then managing your risk so that if outcome B happens, because it will happen sometimes, you lose a teaspoon of water, but when outcome A happens, you gain a bucket. This shift in mindset is what separates the professionals from the amateurs. The amateur wants to be right. The professional wants to be profitable. These are two very different objectives. In this masterclass, we will meticulously cover the three pillars of survival: strategy, risk management, and psychology. You cannot have one without the others. A great strategy with poor risk management leads to a blown account. Great risk management with a poor strategy leads to a slow death by 1,000 cuts. And great strategy and risk management with poor psychology leads to self-sabotage, revenge trading, and hesitation. We will break down popular strategies such as scalping, where you are in and out of the market in minutes, capturing small moves that add up over time. We will look at day trading, where you open and close positions within the same session, avoiding the risk of holding trades overnight. We will explore swing trading concepts that can be applied to lower time frames, allowing you to catch the meat of a trend. But we will not just list them, we will backtest them. We will look at historical data to see how these strategies perform in different market conditions: trending markets, ranging markets, and volatile breakout markets. You will learn to identify which market condition you are in before you even think about placing a trade. This is the deep dive difference. Most people skip the assessment of market conditions and go straight to the entry signal. That is like a surfer trying to catch a wave in a flat lake. It does not matter how good your technique is. If the environment isn't providing the energy, you are going nowhere. Furthermore, we are going to address the elephant in the room: leverage. The United States allows for specific leverage caps, while offshore brokers might offer 500 to 1. We will explain exactly how leverage magnifies your equity volatility, and why less is often more when you are building a career. We will calculate position sizing down to the penny, showing you the mathematical formulas that prevent you from blowing up your account on a single bad trade. We will discuss the concept of risk of ruin, and how to ensure your probability of hitting zero is statistically negligible. This is not going to be a series of short, dopamine-filled clips telling you that you can buy a Lamborghini next week. This is a curriculum. This is work. It requires you to pay attention, to take notes, and to treat this skill with the respect it demands. If you are looking for a get-rich-quick scheme, you are in the wrong place and you should click away now. But if you are ready to treat trading as a business, if you are ready to accept the responsibility of risk, and if you are ready to learn the mechanics of the $7 trillion machine that drives the global economy, then you are in the right place. We are going to strip the market down to its bolts and rebuild your understanding from the ground up. So buckle up, clear your distractions, put your phone on silent. What we are about to cover in this series has the potential to change your relationship with money and markets forever, but only if you commit to the process. We are starting at 0, and we are going to 100, leaving no stone unturned. Welcome to the Deep Dive Masterclass on Forex Day Trading Strategies. Let's begin. To understand day trading strategies, you first have to understand the battlefield. Imagine for a moment that you are standing in the middle of a colossal stadium. In the stands, there are millions of participants. In the VIP boxes, you have the central banks, the Federal Reserve, the European Central Bank, the Bank of Japan, entities with the power to print money and shift the tides of the global economy with a single sentence. Down on the field, you have the massive commercial banks, JP Morgan, Deutsche Bank, Citi, exchanging billions to facilitate global trade for corporations like Apple or Toyota. And then, somewhere in the nosebleed section, squinting at the action through binoculars, there is the retail trader. That is you. That is us. The game on the field is not random. It is a violent, unending tug-of-war between supply and demand, driven by fear, greed, and geopolitical necessity. Let's look at a concrete scenario to illustrate how this mechanism actually moves price. Imagine it is Friday morning, 8:30 a.m. New York time. The market is holding its breath. The non-farm payrolls report, a key indicator of U.S. economic health, is about to be released. In our hypothetical scenario, the consensus among analysts is that the U.S. economy added 150,000 jobs. This expectation is priced in, meaning the current exchange rate of the euro against the US dollar reflects this belief. Now imagine the clock strikes 8 hours and 30 minutes. The data hits the wires. The number is not 150,000, it is 300,000. A massive beat. Suddenly, the narrative shifts in a microsecond. A stronger US economy implies higher inflation, which implies higher interest rates from the Federal Reserve. Higher interest rates make the US dollar more attractive to yield-seeking investors compared to the euro. In that fraction of a second, algorithms programmed by those massive banks on the field react before a human brain can even process the number. They dump the euro and buy the dollar. On your chart, you see a massive red candle plunge downwards. This is not just a red line. This is billions of dollars of capital flowing from Europe to the United States in the blink of an eye. If you were a day trader sitting there without a plan, seeing the price plummet, your instinct might be to panic sell at the bottom. But the professional, the one who understands the why, knows that this initial move is often a knee-jerk reaction. They know that liquidity, the ability to buy or sell without moving the price too much, has just dried up. They wait. This specific event, the reaction to news, is the crucible where strategies are tested. This brings us to the fundamental unit of measurement you must master before applying any strategy: the currency pair. You are never just buying a currency, you are always simultaneously buying one and selling another. Consider the pound sterling to US dollar pair. If you are long or buying this pair, you are effectively betting that the Great British Pound will strengthen relative to the US dollar. You are buying stock in the UK economy and shorting the US economy. It is a relative value trade. This nuance is critical because a currency can be strong in isolation, but weak against a specific counterpart. For example, the Japanese yen might be gaining strength because of a safe haven flow during a crisis, but if the US dollar is gaining strength faster because of aggressive interest rate hikes, the US dollar to Japanese yen pair will still go up. Understanding this dynamic is what prevents you from getting trapped in false moves. Now let's deepen this with a look at the concept of sessions. The Forex market is open 24 hours a day, 5 days a week, but it is not active 24 hours a day. This is a trap for new traders who think they can trade at any random hour. Imagine the market as a global relay race. It starts in Sydney and Tokyo. The Asian session is historically known for lower volatility. It is often where the market consolidates, takes a breath, and establishes a range. If you try to use a high volatility breakout strategy during the Asian lunch hour, you will likely get chopped up, buying the top of a tiny range and selling the bottom, bleeding your account slowly. Then the baton passes to London. This is the heavyweight champion of sessions. London handles a massive percentage of global Forex transactions. When the London session opens around 3 a.m. New York time, the volume explodes. This is where the fake-out often happens. Picture this. During the quiet Asian session, the price of euro to US dollar has been drifting sideways. As London opens, the price suddenly spikes up, breaking the Asian high. Retail traders see this breakout and jump in, buying aggressively, thinking the trend has started. But the institutions know that there is a pool of stop-loss orders sitting just above that high. They push the price up to trigger those stops, grabbing the liquidity they need to sell their massive positions, and then they slam the price down in the opposite direction. The retail trader is left holding a buy order at the absolute peak of the day. This is known as the London breakout trap, and avoiding it requires understanding that the early session moves are often liquidity grabs, not true trends. Finally, New York wakes up. For a few hours from 8 a.m. to around noon New York time, both London and New York are open simultaneously. This is the overlap. This is the golden time for day traders. It is when the highest volume of money changes hands. If you are looking for momentum, if you want the price to move from point A to point B quickly so you can secure your profit and exit, this is the window. After London closes, the New York session tends to drift, and volatility dies down until the cycle repeats. Your strategy must be synchronized with this clock. You do not wear a winter coat to the beach, and you do not trade a trend-following system when the major banks are closed. Let's touch on the mathematics of survival, specifically the concept of the pip and the lot. A pip usually represents the fourth decimal place in a currency quote. If euro to US dollar moves from 1.1050 to 1.1051, that is 1 pip. It sounds microscopic. How can you make a living off 1/100%? The answer is leverage. Leverage allows you to control a large amount of money with a small deposit. Imagine you have a $1,000 account. With 1:100 leverage, your broker allows you to control $100,000 worth of currency. This is a standard lot. If you trade a standard lot, a single pip movement is worth roughly $10. This sounds great when you are winning. 10 pips is $100. A 10% gain on your account in minutes. But here is the imagine if scenario that ruins lives. Imagine you open a standard lot on that $1,000 account. You are feeling confident. You buy euro to US dollar. But the market sneezes. It drops 20 pips against you. That is a $200 loss. You have just lost 20% of your entire trading capital in a heartbeat. If it drops 100 pips, a move that can happen easily in a single day, your account is wiped out. Gone. The broker closes your trade automatically to protect themselves, and you are left with zero. This is why we never ever focus on how much money we can make. We focus on how much we can lose. Professional day traders rarely risk more than 1 or 2% of their account on a single trade. If they have a $1,000 account, they are risking $10 or $20, not $200. This means they adjust their lot size down to a micro lot or a mini lot to ensure that even if they are wrong, they live to fight another day. We have established the arena, the players, the timing, and the mathematical stakes. You now understand that price moves due to institutional order flow and macroeconomic shifts, not magic lines. You understand that timing your entry with global market sessions is crucial for momentum. And you understand that leverage is a double-edged sword that must be handled with surgical precision. But understanding the environment is only step 1. Step 2 is learning how to read the map. How do you look at a naked chart and identify where the institutions are likely to buy or sell? How do you distinguish between a market that is trending and a market that is ranging? Most traders look at a chart and see chaos. They see bars going up and down with no rhyme or reason. But hidden within that chaos is a structure, a DNA of the market, that repeats itself over and over again on every time frame, from the 1-minute chart to the monthly chart. This structure dictates the direction of the trend, and more importantly, it tells you exactly when that trend is about to end. If you can learn to read this structure, you can stop chasing price and start waiting for price to come to you. In the next part of this masterclass, we are going to demystify market structure. We will break down higher highs, lower lows, and the critical concept of the break of structure that signals a reversal. We will show you how to spot the exact moment the tide turns, so you can enter at the beginning of the wave, not the end. You cannot afford to miss this because without market structure, every strategy is just a guess. To master the Forex market, you must stop looking at the chart as a random jagged line and start viewing it as a staircase. This is the essence of market structure. It is the only non-lagging indicator in existence because it is price itself. Every single indicator you download, RSI, MACD, Bollinger Bands, is a derivative of price. They are mathematically calculated based on what price has already done. Market structure, however, tells you what price is doing right now. It is the raw data. It is the footprint of the institutional money we discussed in the previous section. When a central bank or a massive hedge fund accumulates a position, they cannot hide the structure they create. Let's visualize the most fundamental concept, the bullish trend. In a healthy uptrend, price does not shoot up in a straight vertical line. It breathes. It expands and contracts. Price surges upward to create a higher high, representing a wave of aggressive buying pressure. Then, inevitably, profit-taking occurs. The early buyers cash out and the price pulls back. But, and this is the critical part, it does not fall below the starting point of the previous wave. It finds support at a higher level than before. This is the higher low. This higher low is the heartbeat of the trend. As long as price continues to form higher highs and higher lows, the trend is mathematically and technically bullish. It does not matter what the news says. If the structure is bullish, you are looking for buys. Conversely, a bearish trend is the exact inverse. Price pushes down to a lower low, pulls back up but fails to breach the previous high, creating a lower high, and then rolls over again. The lower high is your defense line. In a downtrend, the moment price violates a lower high and closes above it, the structural integrity of the downtrend is compromised. This is the logic we use to determine bias. We are not guessing. We are observing the sequence of highs and lows. Now, imagine a scenario that traps thousands of traders every day. Let's call it the premature reversal. You are watching the euro to US dollar on a 5-minute chart. The trend has been moving up all morning. Suddenly, you see a massive red candle. It looks terrifying. It eats up the gains of the last 30 minutes. Novice traders see this speed and think, the trend is over. Sell. Sell. They jump in short, convinced they caught the top. But they failed to look at the structure. That massive red drop? It was just a pullback. It never broke the previous structural higher low. It simply dipped into a discount area to pick up more buy orders. The institution algorithms see this liquidity, step in, and launch the price upwards again, creating a new higher high. The novice trader gets stopped out, and the trend continues without them. This happens because they mistook a pullback for a reversal. To avoid this, we must define the break of structure, or BOS. A break of structure occurs when price breaks through the previous high in an uptrend, or the previous low in a downtrend and closes beyond it. This confirms that the trend is healthy and continuing. It is a signal of strength. However, the money is often made at the turn, not just the continuation. This brings us to the change of character, often abbreviated as CHOE. This is the first piece of evidence that a trend is ending. Imagine you are watching a ball bouncing down a set of stairs. It hits a step, lower low, bounces up, lower high, drops to the next step, lower low. Suddenly, the ball hits a step, bounces up, and instead of stopping at a lower point, it bounces higher than the previous bounce. It breaks the ceiling. This is a change of character. In trading terms, price in a downtrend fails to make a new lower low, and then rallies to break the most recent lower high. This is the earliest technical signal that the institutional order flow has shifted from bearish to bullish. But here is where it gets complex, and here is where the deep dive really matters. Market structure is fractal. This means the same patterns repeat on every single time frame, from the 1-month chart down to the 1-second chart. This concept is like a set of Russian nesting dolls. Inside a monthly uptrend, there might be a weekly pullback, which looks like a downtrend. Inside that weekly pullback, there might be a daily small uptrend. Let's walk through a detailed imagine-if case study to show you how to weaponize this. Imagine you wake up and open the 4-hour chart for pound sterling to Japanese yen. You see a clear sequence of higher highs and higher lows. The trend is bullish. You identify the most recent higher low. Let's say it is at price level 180.50. You know that as long as price stays above 180.50, the 4-hour trend is up. However, looking at the current candle, the price is pulling back. It is dropping towards 180.50. Now, you zoom into the 15-minute chart. On the 15-minute chart, because the price is pulling back on the 4-hour, the 15-minute structure looks bearish. It is making lower lows and lower highs. This is where the magic happens. Most amateurs will sell on the 15-minute chart because they see a downtrend. But you, the professional, know that this 15-minute downtrend is just a temporary pullback within the massive 4-hour uptrend. You are not looking to sell. You are waiting for the 15-minute downtrend to end. You watch price approach that 180.50 zone. You wait. You are stalking. Suddenly, on the 15-minute chart, price stops making lower lows. It prints a higher low. Then it blasts up and breaks the last 15-minute lower high. Boom. That is a change of character on the 15-minute chart aligned with the 4-hour bullish trend. This is the golden setup. You are entering a buy trade exactly as the short-term momentum aligns with the long-term direction. The probability of this trade working out is exponentially higher than blindly guessing. You must understand that structure is objective, but it requires strict rules. A common question is, does the wick count, or does the body need to close? In this masterclass, we teach that the body of the candle must close past the level to confirm a break of structure. A wick poking through and coming back down is not a break. It is a rejection. It is a fake out. If you treat a wick as a break, you will be trapped constantly. A wick breaking a high and closing back inside the range is often a sign that big players are selling into the breakout, not buying it. You also need to differentiate between swing structure, And internal structure. Swing structure is the major moves, the big picture. Internal structure is the noise in between the major highs and lows. You can have a bullish internal structure while the swing structure is bearish. If you lose sight of the swing structure, you lose sight of the war because you are too focused on a single battle. A major mistake traders make is trying to trade every single change of character they see on the 1-minute chart. If you do that, you will die by 1,000 cuts. The lower the time frame, the less reliable the structure is. A break of structure on the daily chart is a significant market event. A break of structure on the 1-minute chart might just be a commercial bank executing a quick transaction for a client. It means nothing in the grand scheme. Therefore, your primary task before even thinking about strategy is top-down analysis. Start on the daily. Is it an uptrend or downtrend? Mark your swing high and swing low. Drop to the 4-hour. Is it aligned with the daily? Mark your structure. Drop to the 1-hour. This is your roadmap. You only look for trades that align with the higher time frame narrative. If the daily is bullish and the 4-hour is bullish, you have no business looking for sell setups on the 5-minute chart unless you are an extremely advanced counter-trend scalper, which for now you are not. You are a trend surfer. So we have the environment part 2, and now we have the map part 3. We know how to identify the trend and we know how to spot the reversal. But knowing direction is not enough. You can be right about the direction and still lose money if you enter at the wrong price. If you buy at the very top of a higher high just before the pullback starts, you will suffer drawdown, panic, and likely close the trade for a loss just before it goes in your favor. We need to know where to enter. We need to identify the specific zones where the banks have their limit orders waiting. We need to find the engine of the move. This missing link is called supply and demand. It is the methodology of identifying specific price candles that cause the break of structure. These are the zones where price has a statistical memory. When price returns to these zones, it reacts. But not all zones are created equal. Some are gold mines and some are traps. In the next part, we are going to dissect supply and demand with a level of detail you have likely never seen. We will teach you how to spot the imbalance that institutions leave behind. A footprint so clear it almost looks like cheating. You are going to learn exactly which candle to click buy on. Don't go anywhere. You are looking for the footprint of a giant. When a retail trader buys, they might buy 1 lot or maybe 5 lots. It barely scratches the surface of the order book. When a central bank or a massive hedge fund buys, they are often looking to move hundreds of millions, sometimes billions of dollars. They cannot simply click market buy on a billion-dollar position. If they did, they would consume every single sell order available at the current price, then the next price up and the next, driving the price vertically in a straight line. This is called slippage, and it would ruin their average entry price. They would end up buying the top of their own move. To avoid this, they have to be surgical. They have to enter in pieces, or they have to engineer a scenario where there is enough selling pressure from others to absorb their massive buy orders. This specific mechanic leaves a scar on the chart. That scar is what we call imbalance, often referred to technically as a fair value gap (FVG), and the point of origin is what we call an order block. Let's dissect the order block first, but we are going to do it differently than the standard textbook definition. Most people tell you an order block is simply the last down candle before the up move. That is too simplistic and leads to losses. An order block is only valid if it accomplished something significant. Think of it as a launch pad. If a rocket takes off but only goes 10 feet in the air and crashes, the launch pad was useless. We don't care about that launch pad. But if a rocket takes off and breaks the atmosphere, meaning, in trading terms, the price blasted off and caused a break of structure BOS, breaking a previous high, then that launch pad is critical. That specific candle where the price paused, accumulated energy, and then exploded? That is where the institution placed their initial heavy orders. Here is the logic you must internalize. When that massive explosion happens, the institution likely did not get all their orders filled. They might have managed to get 60% of their position into the market, but the price moved away so fast that the remaining 40% is left sitting there as limit orders at that original price level. They are not going to chase the price. They are patient hunters. They will wait for the price to come back down to them. This is why price action is like a magnet. It returns to the source. When price drops back into that order block, it triggers those remaining pending orders and boom, the price flies up again. You are not trying to predict the turn. You are simply placing your entry where the whales have already declared their interest. However, an order block alone is not enough. The market is littered with candles that look like order blocks but fail. The secret verification tool is imbalance. Imagine you are painting a wall and you are in a huge rush. You take your roller and swipe it up the wall as fast as you can. Because you moved so quickly, there are patches where the paint is thin, or you missed the wall entirely, leaving the underlying surface visible. To finish the job properly, you have to go back and fill in those gaps. The market works the exact same way. When price moves too fast in one direction due to aggressive institutional buying, it creates an inefficiency. It offers price only to the buyers, skipping the sellers. The algorithm seeks a fair market, which means it needs to pair buyers and sellers at every price point. If it skips a section, it considers that price range unfair or imbalanced. To spot this on a chart, look at a 3-candle sequence. Look at candle 1, candle 2, the big aggressive one, and candle 3. If the high of candle 1 and the low of candle 3 do not touch or overlap, the space in between them inside candle 2 is the imbalance. This gap is a vacuum. The market hates vacuums. Historically, there is a very high statistical probability that price will reverse its direction specifically to fill this gap before continuing its original trend. This is what we call mitigation. Let's build a deep dive case study to bring this together. Imagine the US dollar to Canadian dollar pair. The trend on the 4-hour chart is bullish. You see the price consolidating, moving sideways for a few hours. Suddenly, a massive green candle erupts, followed by 2 more. This move smashes through the previous resistance, creating a clear break of structure. The retail crowd sees this massive green line and thinks, "It's taking off. I need to buy now." They buy at the top, driven by FOMO, fear of missing out. You, the strategist, do nothing. You sit on your hands. You look at the origin of that move. You identify the last red candle before the explosion. That is your demand zone, order block. You then verify. Did the explosion leave an imbalance? Yes, there is a clear gap between the first candle's high and the third candle's low. This confirms the zone is high probability. You do not chase the price. You set a buy limit order at the top edge of that demand zone. Now watch what happens next. The price starts to fall. The news pundits start saying the rally is over. The retail traders who bought at the top are now in the red. They panic. As the price drops, it hits their stop losses. Their stop loss on a buy trade is a sell order. This selling pressure accelerates the price downwards, faster and faster. It looks like a crash. But where is it crashing to? It is crashing straight into your demand zone. It is acting like a delivery truck, bringing liquidity right to the institution's doorstep. The moment price taps into that order block and fills the imbalance, the institutional limit orders trigger. The supply dries up, the massive buy orders hit the tape, and the price reverses violently, shooting up to make a new high. The retail trader sold the bottom and you bought the bottom. That is the power of supply and demand. But we need to add a layer of sophistication, premium and discount. You would not buy a brand new car for double its retail price, so why would you buy a currency pair when it is expensive? You need to measure the range. If the price moves from point A low to point B high, that is your dealing range. You can use a Fibonacci retracement tool, not for magical levels like 0.618, but simply to find the 50% mark. The top half is premium, expensive. The bottom half is discount, cheap. Rule of thumb: never, ever buy in the premium zone. I don't care how good the order block looks. If it is in the top 50% of the range, the probability is lower because institutions want to buy at a discount. They are wholesalers. You must wait for the price to retrace below the 50% equilibrium level into the discount zone. Only then do you look for your order block and imbalance. Conversely, if you are shorting, you only sell from the premium zone above the 50% mark. This simple filter will save you from buying false breakouts that immediately reverse. Let's refine the entry even further. What happens if you have a massive order block? Let's say on the 4-hour chart, the order block candle is 50 pips wide. If you put your stop loss below it, that is a huge risk. You can refine this zone. When price approaches your 4-hour order block, do not just blindly leave a limit order. Drop down to the 15-minute time frame. Look for the fractal pattern we discussed in part 3. Look for the price to tap the 4-hour zone, and then create a 15-minute change of character, see Hosich. This confirmation entry reduces your risk from 50 pips to maybe 10 pips, allowing you to increase your position size, lot size, while risking the same dollar amount, thereby drastically increasing your potential reward to risk ratio. This sounds perfect, right? It sounds unbeatable. You find the structure, you find the imbalance, you wait for the discount, and you enter. But here is the cold shower. You can follow these rules perfectly and still lose. In fact, many smart money concepts traders get slaughtered because they miss one crucial variable. The market knows you are looking at that order block. The algorithms know exactly where the obvious demand zone is. Sometimes the market will intentionally create a perfect-looking order block just to use it as bait. It lures you in, induces you to buy, and then smashes right through it to grab the stop losses sitting underneath before then going in your direction. This is the cruelest trap in trading. Why does this happen? It happens because of liquidity. For a bank to buy $500 million worth of euro to US dollar, they need $500 million worth of sellers. Where do they find those sellers? They find them by triggering your stop losses. Your stop loss is their fuel. If you don't understand where liquidity is hiding, you are not the fisherman. You are the bait. In the next section, we are going to reveal the concept of inducement and liquidity sweeps. We will teach you how to identify the trap order blocks versus the true order blocks, ensuring you are entering after the slaughter, not during it. This is the missing key that unlocks true consistency. Liquidity is the fuel that powers the Forex engine. Without it, the market stops moving. To understand why you keep getting stopped out exactly 1 pip before the market reverses and goes to the moon without you, you have to understand the predicament of the smart money. Imagine you are a whale in a bathtub. If you move thrash around, the water spills over. You cannot move without creating waves. Now, imagine a major bank wants to enter a long position on euro to US dollar worth $200 million. They cannot just click buy. If they did, they would slip the price upwards instantly, getting a terrible entry price. They need a counterparty. To buy 200 million, they need someone or a collective group of someones to sell 200 million at that exact moment. Where do they find that much selling pressure? They find it in your stop losses. Think about this mechanically. If you are a retail trader and you buy a currency pair, your stop loss is a sell order. If you are short, your stop loss is a buy order. Therefore, if a bank wants to buy, they need to trigger a massive cluster of sell orders. And where are those sell orders hiding? They are hiding right underneath the obvious support levels that every textbook, YouTube guru, and basic course told you to trade. This is the concept of inducement. The market paints a picture that looks too good to be true to induce you into a position early. It creates a double bottom or equal lows. You look at the chart and say, wow, price rejected this level twice. It must be strong support. So, you place a buy limit order at that support, and you place your protective stop loss 10 pips below it. Thousands of other traders do the exact same thing. The algorithm sees this. It sees a massive pool of liquidity sitting just below that double bottom. So what happens? The price approaches the support level. It might even bounce a little bit to give you hope, to validate your bias. Then suddenly it slams down through the support level. It triggers all those stop losses. This flood of sell orders hits the market. Who is on the other side of those sells? The bank. They are absorbing all that selling pressure, filling their massive buy orders at a discount. Once their orders are filled, the selling pressure evaporates, and the price rockets upwards, leaving you with a loss and a feeling of confusion. This move is called a liquidity sweep, or a stop hunt. You must stop looking at support and resistance as concrete walls. They are not walls, they are magnets. Price is attracted to them because that is where the orders are. A key rule in this masterclass is, we do not trade the first move. We trade the reaction to the trap. If you see a perfect double top forming, do not rush to sell. That double top is creating equal highs. Above those highs is a treasure trove of buy stops, from people shorting, and breakout buy orders, from people trying to play the breakout. The market is highly likely to punch through those highs, sweep the liquidity, tag the orders, and then reverse. This brings us to trendline liquidity. This is perhaps the most common trap for intermediate traders. You draw a diagonal trend line connecting two lows. The textbook says, buy on the third touch. The algorithm knows you draw that line. Often, you will see price approach that trend line for the third time. Traders pile in. Then, price smashes through the trend line, creating a panic. Traders think the trend is broken. They close their positions or their stops get hit. Once that liquidity is harvested, the price creates a V-shaped recovery and continues the original trend. If you were trading the trend line touch blindly, you lost. If you were waiting for the sweep of the trend line liquidity, you entered at the absolute bottom. So, how do we distinguish a trap order block from a true order block? In the previous section, we talked about entering on order blocks. But here is the nuance. If an order block forms and leaves inducement sitting right before it, that order block is high probability. Imagine an uptrend. Price creates a strong push-up, order block, but then pulls back and creates a small consolidation or a double bottom just above that order block. This is engineering liquidity. The market is encouraging early buyers to step in before the real zone is hit. Those early buyers place their stops just below their entry, which happens to be right inside or just above your order block. This is perfect. You want those early buyers to be wrong. You want their stops to be the fuel that triggers your entry. When price drops, it takes them out, taps your order block, and flies. However, if you see an order block that has no liquidity built up before it, if the price just drifted away cleanly, be very careful. The market might smash right through that order block to find liquidity lower down. We call this the SMT, or smart money trap. The first order block is often the decoy. The real move happens at the extreme, the very bottom of the structure, or after a significant sweep of a previous swing point. Let's walk through a step-by-step imagine-if execution sequence using this logic. Step 1. You identify a bullish trend on the 4-hour chart. Step 2. You identify a demand zone order block, where the move originated. Step 3. You wait. You watch price return to the zone. Step 4. As price approaches, you look for inducement. Is there a support level forming just above your zone? Yes. Good. That is bait. Step 5. You watch the price sweep that bait. It drops below the support, hitting the retail line. Step 6. Now you do not just buy blindly. You wait for the lower time frame, 15-minute or 5-minute, to confirm the rejection. You want to see the price tap your zone and then violently react upwards, breaking a local structure, change of character. Step 7. Now you enter. This process requires patience. It requires you to sit on your hands while others are clicking buttons. It effectively means you are trading against the retail sentiment but with the institutional intention. You are no longer the prey. You are the scavenger waiting for the predator to finish its meal so you can eat safely. Let's talk about time and liquidity. Liquidity sweeps are highly time-dependent. Remember the sessions we discussed in Part 2? The Asian session often creates a range, a box of liquidity. Above the Asian high and below the Asian low are massive pools of orders. When the London session opens, the Frankfurt Open or London Open, the very first move is often a sweep of the Asian liquidity. If the trend is up, London will often open, drop sharply to sweep the Asian lows, trap sellers, and then reverse to trend up for the rest of the day. If you understand this Asian range sweep model, you can often catch the high or low of the day within the first hour of the London session. Case study: the pound sterling to US dollar London Judas swing. Historically, you will often see pound sterling to US dollar drift sideways from 8 p.m. Eastern Standard Time to 2 a.m. Eastern Standard Time, Asian session. At 3 a.m. Eastern Standard Time, London Open, price aggressively spikes up. Breakout traders buy. But this is a Judas swing, a false move. It sweeps the Asian high liquidity. By 3:30 a.m. or 4 a.m., the price stalls, prints a bearish reversal candle, and then drops 100 pips. The trader who bought the breakout is destroyed. The trader who waited for the sweep and the reversal signal caught the entire daily move. We have now layered the foundation market environment, structure, supply and demand, and liquidity. You know how to read the map, where to enter, and how to avoid the traps. But there is a glaring hole in your arsenal right now. You know how to get in, but you have no idea how to get out. Greed is the destroyer of accounts. Most traders execute a perfect entry, see the numbers turn green, and then they freeze. They hallucinate. They start calculating how much they will make if the price goes to the moon. They turn a winning trade into a losing trade because they don't have a systematic exit strategy. Or worse, they take profit too early, capturing $10 when they could have made $500, simply because they were scared to lose the green. In the next part, we are going to tackle trade management and precision exits. We will discuss the mathematical approach to partial profits, how to trail your stop loss without getting wicked out, and the concept of targeting liquidity, using the same traps we just discussed as your take profit zones. You don't want to miss this, because holding a trade too long is just as dangerous as entering one too early. Let's get your money off the table. There is an old saying on Wall Street: bulls make money, bears make money, pigs get slaughtered. Entering a trade is an act of courage, but exiting a trade is an act of discipline. The moment you are in a winning position, a chemical shift happens in your brain. Dopamine floods your system. You see the unrealized profit fluctuating on your screen, and you start to mentally spend that money. You think, if it goes up another 20 pips, I can pay off my car. If it hits that monthly high, I'm doubling my account. This projection is the enemy. It disconnects you from the reality of the chart and traps you in a fantasy. The market does not owe you a car. It does not owe you a double account. It owes you nothing. If you do not have a hard predefined exit strategy, the market will eventually take back every single cent you made, plus your initial risk. So, how do we determine where to exit? We go back to the core concept we mastered in the previous section, liquidity. Just as institutions need liquidity to enter the market, they need liquidity to exit the market. If you are holding a buy position, to close that position and realize your profit, you must sell. For you to sell, someone must buy. Who is going to buy from you at the top of the move? Ideally, it is the breakout traders chasing the hype and the short sellers getting stopped out. This introduces the concept of external range liquidity. Remember the swing highs and swing lows we marked during our market structure analysis? Those are your targets. If you buy at a higher low in an uptrend, your logical, non-negotiable first target is the weak swing high that the trend is expected to break. Why? Because sitting just above that high is a cluster of buy stops, from bears protecting their shorts, and buy stops from bulls waiting for a breakout. When price smashes through that high, those buy orders trigger. That surge of buying liquidity allows the smart money, and you, to sell your positions into strength. You are effectively selling your position to the people who are late to the party. Let's visualize a specific scenario. Imagine you are trading euro to Japanese yen. You identified a bullish order block in a discount zone. You entered long at 155.00. Your stop loss is at 154.80, a 20 pip risk. Now look left. Where is the most recent significant high? Let's say there is a double top at 155.60. That represents equal highs. We know from the previous section that equal highs are a magnet for price. The algorithm wants to run those highs to clear the books. Therefore, 155.60 is your take profit zone. It is not a guess. It is a structural target. You are aiming for a 60 pip gain with a 20 pip risk. That is a 1 to 3 risk to reward ratio. However, price rarely moves in a straight line. It creates turbulence. This is where trade management saves you from psychological torture. You need a system for partial profits. Many novice traders hold their full position until the final target. This is technically maximizing profit, but it maximizes emotional stress. If price goes to 155.50, 10 pips from your target, and then violently reverses all the way back to your stop loss, you have turned a winner into a loser. That psychological damage is worse than the financial loss. It destroys your confidence. To combat this, we implement a tiered exit strategy. A common professional approach is the twin trade, or scaling out method. Let's say you want to risk 1% of your account. Instead of opening one position with a 1.0 lot size, you open two positions with 0.5 lots each. They have the same entry and the same stop loss. As price moves in your favor and hits a 1-to-1 or 1-to-2 risk-to-reward ratio, or hits a minor internal resistance level, you close one of the positions. You bank 50% of the trade. Simultaneously, you move the stop loss on the remaining position to break even your entry price. Think about what you just achieved. You have realized profit. That money is in your balance. It is yours. And the remaining half of the trade is now completely risk-free. If the market crashes, you get stopped out at break-even on the second half, but you still walk away with the profit from the first half. You have removed the stress. You are now playing with house money. This allows you to hold that second position much longer, aiming for those ambitious higher time frame targets without the fear of losing your capital. This simple mechanical adjustment changes you from an anxious gambler into a calm operator. Now let's address the trailing stop. When should you move your stop loss? Most traders move it too early. They see a little green and move their stop to break even immediately because they are scared to lose. The market breeze fluctuates. If you choke the trade by moving your stop too close too soon, you will get wicked out. The price will tap your stop, kick you out for zero profit, and then run to your target without you. The rule for trailing is, only trail your stop behind a confirmed structural level. In a bullish trade, you are waiting for a new higher low to form and confirm. Price creates a higher high. Price pulls back and forms a higher low. Price breaks the new higher high. Only after step 3 happens do you take your stop loss from the original position and move it underneath the new higher low. This gives the trade structural breathing room. The price can wobble and chop, but as long as the trend structure holds, you stay in the trade. You repeat this process, step laddering your stop loss up, until the market eventually reverses and takes you out. This way you don't guess the top. You let the market tell you when the trend is over. There is another critical aspect of exits: the time-based exit. We discussed sessions earlier. If you are a day trader, you should generally not be holding trades overnight or through the weekend, unless you are specifically swing trading. The risk of gapping, where price opens significantly higher or lower than it closed, is too high. If you are in a trade during the New York session, and the clock is ticking towards 5 p.m. Eastern Standard Time market close, liquidity is drying up. Spreads, the difference between buy and sell price, will widen. Volatility will die. Even if your target hasn't been hit, the professional move is often to manually close the position. Do not hope for a miracle in a dead market. Take what the market gave you and leave. Let's look at a scenario of disaster to reinforce why this matters. Imagine you are short on pound sterling to US dollar. You are up 50 pips. You are feeling like a genius. You have no take profit set because you think the British economy is collapsing. This is going to zero. You go to make a coffee. While you are away, a breaking news headline hits. UK inflation data comes in hotter than expected. The algorithm reacts instantly. GBP spikes 80 pips in 1 minute. You come back to your screen. Your plus 50 pips is now minus 30 pips. You freeze. You think, it will come back down. It has to. You hold. It goes up another 20 pips. Now you are down minus 50 pips. Panic sets in. You finally close the trade at the top, taking a massive loss on a trade that was a massive winner. This scenario happens every single day to thousands of people. It is avoidable with one button: take profit. You must respect the data. If the average daily range ADR of a pair is 80 pips, and the pair has already moved 75 pips today, the statistical probability of it moving another 50 pips is incredibly low. Do not try to squeeze water from a stone. If the daily range is exhausted, get out. You also need to understand fixed RR versus structural RR. A fixed RR trader says, I always exit at 1:2. This is good for consistency but bad for context. A structural RR trader says, I exit at the next liquidity pool. Sometimes that is 1:5, sometimes it is 1 minute and 1.5 seconds. If the structural target offers less than a 1:1 reward, you do not take the trade. This is the ultimate filter. Before you enter, you measure the distance to the target, liquidity, and the distance to the invalidation point, stop loss. If the target is 20 pips away and the stop is 30 pips away, the math is broken. You are risking $30 to make $20. The casino has better odds than that. You must skip that trade even if you think it will win. Over a series of 100 trades, negative risk to reward will bankrupt you. We have covered how to analyze, how to enter, and how to exit. You have the mechanics of the car. But we haven't talked about the fuel gauge. We haven't talked about the one mathematical certainty that determines whether you survive long enough to become profitable. You can have the best strategy in the world, a 90% win rate, and still blow your account in a single week if you get this next part wrong. I am talking about risk management and position sizing. This is the boring topic that no one wants to click on, but it is the secret that separates the millionaire traders from the gamblers. Do you know exactly how to calculate your lot size so that you lose exactly $50 regardless of whether your stop loss is 10 pips or 100 pips? Do you know the risk of ruin formula? In the next part, we are going to do the math. We are going to build a bulletproof shield around your capital so that you can survive the learning curve. This is the most important lesson of your career. Trading is a business of survival. It is not about hitting a home run on your first day. It is about staying in the game long enough for the law of large numbers to work in your favor. If you blow your account in week 1, it does not matter if you have the best strategy in the world. You are out of chips. You are sitting on the sidelines watching everyone else play. The only barrier between you and the inevitable zero balance is risk management, specifically the mathematical art of position sizing. Most new traders approach the market with a lot size mentality. They think, I have a $1,000 account, so I should trade 0.1 lots. Or, I want to make money fast, so I will trade 1.0 standard lot. This is suicide. This is not trading. It is gambling with a blindfold on. The size of your trade should never be a fixed number you pick based on how you feel. The size of your trade is a dynamic variable that changes every single time you click the button, based strictly on the distance of your stop loss. Let's break this down with a hard non-negotiable rule, the 1% rule. Professional traders rarely risk more than 1% of their total account equity on a single trade idea. If you have a $10,000 account, your maximum allowable loss on any single trade is $100. Not $101. Not $200 because you feel lucky. $100. Period. This number, the dollar amount at risk, is the only constant. Everything else adjusts around it. Here is the imagine if scenario that will change how you view leverage forever. Imagine you spot two different trade setups on the euro to US dollar pair. Setup A is a scalp. You are entering on a 5-minute chart. Your entry is precise and your stop loss is very tight, only 5 pips away from your entry. Setup B is a swing trade. You are entering on a 4-hour chart. You need to give the trade room to breathe, so your stop loss is 50 pips away from your entry. If you were the amateur using a fixed lot size of 1.0 standard lot, which pays roughly $10 per pip, for both trades, look at the disaster you would create. In setup A 5 pip stop, if you lose $50. That is 0.5% of your account. Safe. In setup B 50 pip stop, if you lose $500. That is 5% of your account on a single trade. If you take 3 losses in a row on setup B, which is very common in trading, you are down 15%. Your account is bleeding out. You are emotionally compromised. You start revenge trading to make it back, and soon you are down 40%. Now, let's look at how the professional handles this using dynamic position sizing. The professional knows they can only lose $100, 1% of $10,000. For setup A 5 pip stop loss, they take their risk amount, $100, and divide it by the stop loss distance, 5 pips. The result allows them to trade a massive 2.0 lots. $20 per pip x 5 pips equals $100 risk. For setup B 50 pip stop loss, they take their risk amount, $100, and divide it by the stop loss distance, 50 pips. The result dictates they must trade a much smaller 0.2 lots. $2 per pip x 50 pips equals $100 risk. Do you see the magic here? In both scenarios, the risk is exactly the same. $100. It does not matter if the stop loss is 5 pips or 500 pips. The monetary loss is identical. This removes the fear of volatility. You are no longer afraid of a big stop loss because you simply reduce your lot size to compensate. You are mathematically neutral. You have inoculated yourself against a catastrophic blowout. You might be thinking, but 1% is too slow. I want to grow my account fast. Let me introduce you to the math of ruin. This is the statistical probability that you will lose your entire account based on your win rate and your risk per trade. If you risk 10% per trade trying to get rich quick, and you have a losing streak of just 5 trades, which happens to even the best hedge fund managers in the world, you have lost roughly 41% of your capital. If you risk 1% per trade, and you have that same 5-trade losing streak, you are down roughly 4.9%. You are basically scratching the surface. You can sleep at night. You can come back tomorrow with a clear head. Furthermore, you need to understand the drawdown recovery matrix. This is the hole you dig for yourself when you lose money. The math of recovery is not linear. It is exponential. If you lose 10% of your account, you need to make an 11% gain on the remaining balance to get back to break-even. That is doable. If you lose 50% of your account, you do not need a 50% gain to recover. You have $5,000 left of your $10,000. To get back to $10,000, you need to double your money. You need a 100% gain just to get back to zero. If you lose 90% of your account, you need a 900% gain to recover. That is statistically impossible for a beginner. This is why we protect capital at all costs. The moment you drop below 20% drawdown, the math turns against you so violently that you are effectively dead in the water. By sticking to 1% risk, you would need to lose 100 trades in a row to blow your account. Even a coin toss wouldn't lose 100 times in a row. You are effectively engineering your survival. Let's touch on correlated exposure. This is a hidden killer. You might think, okay, I will risk 1% on euro to US dollar, 1% on pound sterling to US dollar, and 1% on Australian dollar to US dollar. I am safe. Wrong. You just risked 3% on the US dollar. If the US dollar strengthens, euro to US dollar drops, pound sterling to US dollar drops, and Australian dollar to US dollar drops. You lose all 3 trades simultaneously. You didn't have 3 diversified trades. You had one giant trade split into 3 parts. You must be aware of currency correlations. If you are betting against the dollar, do it on one pair, Or split your risk, 0.5% on euro, 0.5% on pound. Do not triple your exposure unknowingly. Now let's talk about asymmetric compounding. This is how you actually get rich without risking more than 1%. It is the eighth wonder of the world. If you risk 1% and you target a 1 to 3 risk to reward ratio, as we discussed in the strategy section, 1 win covers 3 losses. Imagine you take 10 trades. You lose 7 of them. You are a terrible trader with a 30% win rate. Losses: 7 trades x minus 1% equals minus 7%. Wins: 3 trades x plus 3% equals plus 9%. Net result: plus 2%. You were wrong 70% of the time and you still made money. This is the power of high risk to reward combined with strict risk management. You do not need to be a fortune teller. You just need to be a casino. The casino loses hands all the time, but the math is rigged so that they always win the night. You are rigging the math in your favor. To implement this tomorrow, you need a tool. You cannot do this in your head. Before every trade, open a position size calculator. Available for free online or as an app. Step 1. Enter your account balance. Step 2. Enter your risk percentage, 1%. Step 3. Enter your stop loss in pips, derived from your technical analysis, not a random number. Step 4. The calculator gives you the lot size. Step 5. You enter that exact lot size into your trading terminal. This process separates the emotional human from the execution. It makes you a machine. When you lose, you shrug. It costs me 1%. I'll make it back on the next 1:3 winner. When you win, you don't get euphoric. It's just another data point. But here is the catch. You can have the strategy, parts 1 to 4. You can have the liquidity concepts, part 5. You can have the exit plan, part 6. You can even have this mathematical shield, part 7. But there is one enemy left that is stronger than all of these combined. It is the enemy staring back at you in the mirror. You see, knowing what to do is easy. Doing it when your heart is pounding, when the market is screaming, when you have lost 3 trades in a row, and you just want to get it back. That is the hardest thing in the world. The psychology of trading causes 99% of people to throw this risk management plan out the window the moment they feel pain. They delete the stop loss. They double the lot size. They self-destruct. In the next part, we are going deep into trader psychology and emotional control. I am going to show you why your brain is biologically wired to fail at trading, and I will give you the specific mental frameworks, the hacks, to override your primitive instincts and trade like a cold, calculated professional. This is the final frontier. Without it, the math means nothing. You are fighting 4 million years of evolution. Your brain was designed to keep you alive on the savannah, not to trade the euro against the dollar. When a caveman saw a predator, his amygdala, the lizard brain, hijacked the system. It flooded the body with cortisol and adrenaline, shutting down the prefrontal cortex, which is responsible for logic, long-term planning, and rational decision-making. The goal was simple: fight or flight. There was no time for analysis. Shutterstock. In trading, this biological mechanism is your greatest enemy. When you see a large red candle dropping against your position, your brain does not see a financial fluctuation. It sees a saber-toothed tiger, perceives a threat to your survival. The amygdala screams, "Do something, now!" You panic. You sell at the bottom. Or conversely, when you see a green candle shooting up without you, your brain screams, "The tribe is eating and you are starving. Run to the food." You buy at the top. This is not a lack of intelligence, it is biology. To become a professional trader, you effectively have to rewire your brain to act against your own survival instincts. You have to learn to run toward the fire when it makes sense, and stand still when every fiber of your being wants to run away. Let's dissect the specific psychological viruses that infect your trading, starting with the most pervasive one, loss aversion. Behavioral economists have proven through prospect theory that the pain of losing $100 is psychologically twice as powerful as the pleasure of gaining $100. Giddy images. Explore. Imagine if you are in a trade. It goes into profit by $50. Your heart races. You think, "I better take this now before the market takes it back." You close the trade for a small win. 10 minutes later, the price explodes in your direction, and you would have made $500. You cut your winner short because you were afraid of the pain of losing the gain. Now imagine the inverse. You enter a trade, and it immediately goes negative by $50. Your logic says, my thesis is invalid, I should cut my loss. But your ego says, no, it will come back. I can't take a loss. If I close it, the loss is real. If I hold it, there is still hope. So you hold. The loss grows to 100, then 200. You are paralyzed. You are now hoping, not trading. Eventually, the pain becomes too great, and you close the trade at the absolute bottom for a massive loss. This behavior, cutting winners early and holding losers late, is the exact mathematical inverse of a profitable strategy. It is the default setting of the human brain, and it guarantees bankruptcy. Next, we have the recency bias and the gambler's fallacy. Imagine you have lost 3 trades in a row. A standard probability sequence says that these 3 losses have absolutely zero impact on the outcome of the 4th trade. The coin has no memory, but your brain connects them. You think, I have lost 3 times, so I am due for a win. You increase your risk on the 4th trade, convinced the universe owes you a green number. This is the gambler's fallacy. The market owes you nothing. When that 4th trade also loses because you forced a bad setup, you enter a state called tilt. Revenge trading is the result of tilt. This is the most destructive state a trader can enter. It usually happens after a near miss or an unfair stop out. You get stopped out by 1 pip and then the price goes to your target. You feel violated. You feel like the market attacked you personally. In a rage, you click buy again immediately with double the lot size without checking the structure, without checking the news, purely to get your money back. You have now stopped being a trader and started being a gambler in a rage. The market will mercilessly slaughter you in this state. I have seen traders blow 6 months of consistent profits in one single afternoon of revenge trading. So how do we fix this? We cannot remove the emotions, we are human, but we can build frameworks to contain them. The first framework is thinking in probabilities, popularized by the legendary trading psychologist Mark Douglas. You must accept that you cannot predict the outcome of any single trade. It is a random event. However, you can predict the outcome of a series of trades. Shutterstock. Explore. Imagine you are the casino. The casino does not care if a player wins a jackpot on the slot machine. They do not get angry. They do not panic. Why? Because they know the math. They know that over 1,000 spins, the house edge guarantees they will make money. You need to adopt the 20 trade sample size mentality. Stop judging your success or failure on the trade you are in right now. Commit to taking 20 valid setups according to your strategy. Do not look at your P&L, profit and loss, until the 20 trades are complete. If you lose trade number 5, it is irrelevant. It is just one data point in a set of 20. This simple shift detaches your ego from the immediate outcome. You are no longer trying to be right. You are just executing the system. The second framework is the mechanical circuit breaker. You need a hard rule that stops you from yourself. If you lose 2 trades in a single day, you are done. You close your platform. You walk away. You do not look at the charts on your phone. You are finished for the day. Why? Because after 2 losses, your psychological capital is depleted. You are statistically more likely to make an emotional error on the 3rd trade. By forcing a walk-away rule, you live to fight another day. You preserve your capital for when your head is clear. The 3rd framework is the emotional journal. Most people journal their entry and exit price. That is useless if you don't journal your mind. You need to write down exactly how you felt before you clicked the button. Were you anxious? Were you bored? Did you just see someone on Twitter make money and feel FOMO? If you write down, I am feeling bored and want action, and then you look at your trade setup, you will often realize there is no setup. You are just boredom trading. The act of writing it down forces the prefrontal cortex to re-engage and override the amygdala. Let's look at a case study of transformation. Meet Sarah. Sarah was a decent analyst. She could mark up charts perfectly, but for 2 years she lost money. Why? Because every time she had a winning trade, she closed it for $20 profit, and every time she had a losing trade, she held it for $100 loss. She had a 60% win rate, but her account was slowly dying. She implemented the set and forget protocol. Step 1. Calculate the position size, 1% risk. Step 2. Set the entry, stop loss, and take profit. Step 3. Close the laptop. She was physically not allowed to touch the trade once it was live. She could not move the stop. She could not close early. The result? Her win rate actually dropped to 45% because she stopped taking micro profits. But her risk-to-reward ratio skyrocketed. She started hitting her 1:3 targets. Her average win became $300, and her average loss was fixed at $100. Despite winning less often, she became profitable within 3 months. She removed the human variable from the management phase. You have to understand that trading is a mirror. It reflects your own insecurities, your lack of discipline, and your need for control back at you. If you are impulsive in life, you will be impulsive in the markets. If you are hesitant in life, you will miss entries in the markets. The chart does not lie, but there is a way to build confidence without risking your life savings. There is a way to train your brain to trust the probability without suffering the financial trauma of the learning curve. You wouldn't fly a fighter jet without spending hundreds of hours in a simulator first, right? Yet, millions of people deposit their hard-earned savings into a live Forex account without ever having simulated their strategy. This brings us to the technological edge. We need to prove that our strategy works. We need data. We need to see what the last 5 years of price action would have done to our account if we followed our rules. This process is called backtesting, but most people do it completely wrong. They cheat. They look forward at the chart and say, "Oh yeah, I would have bought there." That is not backtesting, that is hallucinating. In the next part, we are going to dive into the science of backtesting and data analysis. I am going to show you the software, the methodology, and the exact spreadsheet metrics you need to track, like maximum adverse excursion and strike rate, to know with mathematical certainty that your strategy is a winner before you ever risk a single real dollar. This is how you build the conviction of a machine. Let's get to the lab. Confidence is not a personality trait. In the world of high-stakes finance, confidence is a mathematical byproduct of verified data. If you walk into a trade feeling hopeful, you have already lost. You should walk into a trade feeling bored, because you have seen this exact setup play out 1,000 times before in the simulator. You know the statistics. You know the fail rate. You know the expectancy. This is the difference between a gambler and a casino owner. The gambler hopes to win. The casino owner knows that over the long run, the math makes winning inevitable. To achieve this state of zen-like certainty, you must enter the lab. The lab is where you will spend 90% of your time as you develop. In modern trading, this is achieved through a feature called bar replay, available on platforms like TradingView. This tool allows you to slice the market data back to a specific point in time, say January 1st, 2020, and replay the price action candle by candle. This is your flight simulator. You cannot become a pilot by reading a book about aerodynamics, you have to fly the hours. Similarly, you cannot become a trader by looking at a static PDF of chart patterns. A static chart lies to you. It shows you the end result, the clean move, the perfect breakout. It hides the psychological terror of the wick that dropped 10 pips against you before the move started. It hides the 3 hours of consolidation where you would have doubted your thesis. Here is the rigorous protocol for backtesting that separates the amateurs from the professionals. You do not just scroll through the chart and say, "I would have bought there." That is confirmation bias. You must use bar replay. You mask the future data. You let the candles print one by one. You wait for your specific setup, the break of structure, the return to order block, the liquidity sweep. When you see it, you use the long position or short position tool to place your hypothetical entry, stop loss, and take profit. Then and only then do you press play. You watch the trade play out. If it hits your stop, you record a loss. If it hits your target, you record a win. You do not cheat. You do not say, "Oh, I would have moved my stop." If your rules didn't say move the stop, you take the full loss. You need to feel the sting of the loss in the simulation so you don't fear it in the live market. You are going to log every single simulated trade into a spreadsheet. This spreadsheet is your business plan. It needs specific columns, and we are going to drill down into the advanced metrics that most educators ignore. Everyone tracks win rate and profit, but those are vanity metrics. We need to track efficiency. The first advanced metric is maximum adverse excursion, MAE. This measures the maximum amount of heat or drawdown the trade took before it went to your target. Let's say you consistently set a 20 pip stop loss. After backtesting 100 trades, you analyze your MAE data. You discover that on your winning trades, the price never went more than 5 pips against you. This is a revelation. It means your 20 pip stop is inefficient. You are leaving money on the table. You can confidently reduce your stop to 10 pips. By cutting your stop in half, you effectively double your risk-to-reward ratio. A 1:3 trade becomes a 1:6 trade, not because you predicted a bigger move, but because you optimized your risk based on hard data. The second metric is maximum favorable excursion, MFE. This measures how far the price went in your favor before reversing. Maybe you target a fixed 1-to-3 ratio, but your MFE data shows that 80% of the time, the price runs to a 1-to-5 ratio before reversing. You are getting out too early. The data is screaming at you to hold longer or to use a trailing stop to capture that extra expansion. Without backtesting, you are guessing. With backtesting, you are optimizing. Let's look at a case study of a trader we will call Michael. Michael loved the Asian session breakout. He saw on YouTube that when London opens, price breaks the Asian range. He looked at historical charts and saw big green candles every morning at 3 a.m. He was excited. He funded a live account. He lost 30% of his money in 2 weeks. Why? Because on the static chart he saw the move. But in the live market he didn't account for the fake out. Michael went back to the simulator. He backtested 500 days of the London Open. He realized that 60% of the time the first breakout was a trap. The price would break up by 5 pips, trigger the buy orders, and then crash down. He realized his strategy had a negative expectancy. He was trading a losing system. The simulator saved him from losing the rest of his money. He tweaked the strategy. I will wait for the first breakout to fail, and then trade the reversal. He tested that hypothesis over 500 trades. The result? A 55% win rate with a 1:3 risk to reward. He found his edge. He didn't find it by guessing. He found it by mining the data. Once you have a backtested strategy with a positive expectancy over at least 100 trades, you move to phase 2, forward testing, the demo. Backtesting has one flaw. It lacks the pressure of time. You can fast forward through a boring day in seconds. In live trading, you have to sit there. You have to wait. This is where patience is tested. You must trade a demo account, paper money, exactly as if it were real money. If you have $5,000 to invest, do not open a $100,000 demo account. Open a $5,000 demo account. Treat it with the same respect. If you blow the demo, you reset and start over. You do not deposit a single penny of real capital until you can hold a demo account profitable for 2 consecutive months. This is the tuition fee. The market charges tuition. You can pay it in virtual money during the testing phase, or you can pay it in real money during the live phase. The choice is yours. During this forward testing phase, you are also testing the friction of the market. You are learning about spreads. In backtesting, 1.1050 is 1.1050. In the live market, you buy at 1.1050, but you get filled at 1.1052 because of the ask price. Those 2 pips matter. You are learning about slippage during news events. You are learning that sometimes you click close, and the terminal freezes for a second. These are the mechanical realities that a spreadsheet cannot show you. You will also encounter the drawdown of boredom. You might have a great strategy that only offers 3 setups a week. In backtesting, that's fine. You just click next day. In real life, that means Monday is empty. Tuesday is empty. Wednesday morning is empty. You are itching to trade. You start inventing setups that aren't there just to feel productive. This is where most traders fail the forward test. They cannot handle the inactivity. You must learn that cash is a position. Being out of the market is an active strategic choice. You should aim for a sample size of 20 trades in your forward test. This is your batch. Trade 1 win. Trade 2 loss. Trade 3 loss. Trade 20 win. At the end of the batch, you calculate your strike rate and profit factor. If the curve is up, you have proof of concept. You have permission to go live. If the curve is down, you go back to the lab. There is no shame in going back to the lab. The only shame is losing real money on a guess. This process, strategy design, backtesting, optimization, forward testing, is the scientific method applied to finance. It removes the mysticism. It stops you from looking for a guru to give you signals. You don't need signals. You have your own data. You are self-sufficient. You know that even if you lose today, your strategy prints money over the course of a year. That knowledge is the armor that protects you from emotional collapse. Now you have the vehicle, strategy, the insurance, risk management, the driver, psychology, and the map, data. You are ready to drive. But the road is long. Trading is not a sprint, it is a lifestyle. It requires a specific daily routine to maintain peak performance. You cannot roll out of bed hungover 5 minutes before the bell and expect to compete with Goldman Sachs. You need a professional routine. In the final part of this masterclass, we are going to break down the daily routine of a 7-figure trader. We will cover the pre-market checklist, the news analysis protocol, the post-market review, and how to balance trading with a full-time job or life commitments. We will show you how to structure your day so that trading serves your life, rather than consuming it. This is the operational manual for your new career. Let's bring it all home. You cannot perform at an elite level with a chaotic life. If you wake up 10 minutes before the New York opening bell, roll out of bed, grab a coffee, and immediately start clicking buttons because you see a green candle, you are not a trader. You are a liquidity provider. You are the easy money that the professionals are harvesting. The most successful traders I know, the ones managing 7- and 8-figure accounts, are boring. Their lives are incredibly structured. They treat trading not like a video game, but like a high-performance sport. Just as an Olympic sprinter has a warm-up routine to prevent injury and ensure peak output, a professional trader has a pre-market routine to prevent financial injury and ensure peak decision-making. Let's construct the ideal trading day. This is your operational manual. It begins the night before. You cannot have clarity in the morning if you are exhausted. Sleep hygiene is technically a trading edge. If your brain is fogged, your impulse control is weakened. The amygdala, that fear center we discussed in Part 8, becomes hyperactive when you are sleep-deprived. So, step 1 is ensuring you are physically ready to process information. The pre-market routine starts 60 minutes before your chosen session begins. Let's assume you are trading the New York session, which opens at 8 a.m. Eastern Standard Time. You are at your desk at 7 a.m. You are not looking at charts yet. First, you check the red folder news events. You go to an economic calendar and look for high-impact data releases, CPI, NFP, interest rate decisions, or speeches by central bank chairmen. Why? Because if Jerome Powell is speaking at 10 a.m., all the technical analysis in the world is secondary. The market will likely go into a holding pattern or consolidation until that speech. If you didn't check the calendar, you might enter a trade at 9:30 a.m., watch it stagnate for 30 minutes, and then get stopped out by a massive volatility spike at 10 a.m. The professional knows to step aside during these events. They mark the no-fly zone on their chart, a vertical line indicating when not to trade. Once the news landscape is clear, you begin your top-down analysis. Exactly as we learned in Part 3, you open the daily chart. You ask, is the day likely to be bullish or bearish based on yesterday's close? You mark your daily highs and lows. You drop to the 4-hour chart. You mark your swing structure. You drop to the 15-minute chart. You mark your order blocks and liquidity pools. This is the critical part. You create a game plan. You write down physically or digitally an if-then statement. For example, if price drops into the 1.0500 demand zone and creates a change of character, then I will buy. If price breaks below 1.0480, I will do nothing. This script is your contract with yourself. When the market opens and the candles start flying, you are not thinking. You are executing the plan you made when you were calm. If the market does something that is not in your plan, you do not trade. You sit on your hands. The no-trade days are often the most profitable days because they are the days you didn't lose money on a subpar setup. Now let's talk about the session itself. Deep work. You cannot trade while scrolling TikTok, watching Netflix, or answering emails. Multitasking is a myth. It is just rapid task switching that degrades your IQ. When you are in your trading window, which should ideally be no more than 2 to 3 hours, your phone is in another room. You are stalking the setup. However, stalking does not mean staring at every tick. That leads to hypnosis and overanalysis. You use alerts. If your demand zone is at 1.0500, set an alert at 1.0510. Go read a book. Go do some push-ups. When the alert triggers, then you come to the screen to look for the entry confirmation. This technique preserves your mental capital. It keeps you fresh for the moment of execution. What if you have a full-time job? This is the reality for 90% of aspiring traders. You might think you are at a disadvantage, but I argue you have a massive advantage. The full-time employee does not need to make money today to pay rent. This removes the desperation that kills full-time traders. If you have a 9-to-5 job, you have two options. Option A, the session overlap. If you live in the US, the New York Open 7 a.m. to 9 a.m. often happens before work. You can trade that high-volume window and be done before your first meeting. Option B, swing trading. Instead of trying to catch 15-minute moves, you trade the 4-hour chart. You analyze the market at night. You set limit orders at your levels. You go to work. You let the market come to you. You check your phone once at lunch to manage the trade, and once at dinner. This style is often more profitable because you are less likely to micromanage the trade and close it early out of fear. You are forced to let the trade breathe. Post-market routine, the audit. The trading day does not end when you close the software. It ends when you journal. We discussed the metrics in part 9, but here is the daily ritual. You take a screenshot of your chart. You draw on it. You mark exactly where you entered and where you exited. You write a brief note about your mental state. I entered early because I was impatient. I held to the target perfectly. You grade yourself A through F. Crucially, you grade your execution, not your P&L. If you took a terrible impulsive trade and made $1,000, that is an F. You got lucky, and that luck reinforces bad habits. If you took a perfect strategy setup and lost $100, that is an A. You followed the process. The outcome was random, but the process was professional. Over time, A grades lead to wealth. F grades lead to ruin, regardless of the short-term result. Then you disconnect. This is the walk away. You must have a life outside of the charts. If your entire self-worth is tied to the movement of a currency pair, a losing streak will destroy you as a person. You need hobbies, relationships, and physical activity to metabolize the stress of the market. The best traders I know are often fitness enthusiasts or gamers or musicians. They have an outlet that has nothing to do with money. We have now traveled a long road together. We started with the harsh reality of the 90/90/90 rule. We dismantled the myths of the casino. We built the foundation of market structure, layered on the precision of supply and demand, and learned to spot the liquidity traps that hunt the uninformed. We engineered a mathematical shield with risk management, rewired our brains to accept uncertainty, and verified our edge in the backtesting lab. Finally, we structured our lives to support this endeavor. You now possess the complete framework. You have the map, but I cannot walk the path for you. The journey from knowing to being is a lonely one. There will be days when you want to quit. There will be weeks where the market just doesn't make sense. There will be moments of doubt where you think you aren't smart enough. In those moments, remember this. Every single professional trader was once a disaster. Every master was once a beginner who refused to give up. The market is not a place for the talented. It is a place for the persistent. It is a mechanism that transfers wealth from the impatient to the patient. You are building a skill that can feed you for the rest of your life. It is a skill that offers true freedom, location freedom, time freedom, financial freedom. But the market demands a price for that freedom. The price is discipline. The price is humility. The price is the willingness to be wrong over and over again until you learn to be right. Do not rush. Do not try to get rich next month. Treat the next 12 months as your university degree. Protect your capital. Respect the risk. Trust the data. And most importantly, trust yourself. You are ready. The market is open. The rest is up to you. Thank you for committing to this deep dive masterclass. If you found value in this series, if it gave you a moment of clarity in the noise, then we have done our job. But the learning doesn't stop here. Markets evolve and so must we. We are already in the lab working on the next series, analyzing the emerging trends in cryptocurrency and algorithmic equity trading. You won't want to miss what's coming next.